if gold goes in a bull era, because if gold goes in a bull era, that's when silver has a chance of doubling and doubling again. That's when everything goes bonkers. That's when oil goes whatever to up to $200. You get these crazy targets, right? $8 copper. So here's the distance from moving average. The same thing. It's objective and unbiased. The same exercise we did for gold. Any instrument, you could do it for SPX. Here's SPX. I'll stretch it a little bit. So we got this stretch from its 3 moving average SPX from the monthly chart. Oh, I got 20.
Yeah.
Here's
Look at that.
So we were pretty stretched. This one here, this crazy one was the 1929 market crash there. This one here.
Mhm.
So whenever you're stretched that much, here's the dot-com bubble right here, stretch, and then after that rolls over. So that's how stretched we are. But it's not just the fact that we're stretched, Andy. It's you're stretched, but after that you can't get stretched anymore where you lose rising trend lines, right? Stretch, can't maintain that distance away. And then you're starting to stumble on your own feet, running out of gas. And look, the momentum is falling apart for the SPX. It's falling apart. So right now, on the distance for moving average, you have a lower high. Here on the price, you have a higher high. That's negative or bearish divergence, whatever you want to call it. The only thing missing is, look, how many days are left in the month? It's in survival mode right now.
Yeah, it looks like it broke it.
It broke that rising trend line, but it still hasn't closed below the 12-month moving average. Because I'll show you this.
Yep.
It needs to. I'm putting the U.S. indicators, recession indicator overlaid. You need a close. Okay, I'll zoom in for you guys here. These rising, it's the close below the 12-month moving average that really spooks, and then you get a recession right after, right? Not every single close below the 12-month moving average leads to a recession, but if you have a close below the 12-month moving average and you're starting to lose rising trend lines, in conjuncture with gold on its own, on the gold to SPX chart, that thing's starting to break out, then you got a problem on your hands. Here, I'll show you here. Here's in the 2007. Here was try to survive. See these wicks. The price during the month, it was below that 12-month moving average, but the buyers came in. There's still a little bit of buying pressure. And eventually that one closed right below 12-month moving average. And after that, that's closed below that one. You lost momentum. Gold was breaking out versus SPX at that moment. And it just vomited, right? So we're back here. Gold to SPX is like starting to trend upwards. It's breaking out of the descending trend lines. It's not fully in the new uptrend, but it's getting real close to that. And look what the SPX is doing. Lost momentum on the monthly chart and lost a rising trend line. And as soon as it closes below that 12-month moving average, I don't know. I think it's going to survive the month there. But if ever, look, during the month, it was really bad there. Like right before this bottom and rally we've had in the past week or so there, it was like all the way down here. So imagine it's not looking great for the SPX. For the SPX to go back and flourish into a new bull market, I would probably need, to see that the price go sideways, grind a little bit, let that 3-year moving average catch up, and then eventually, have a breakout, just like it did here, huge correction. So while everybody might think that this rally is the one that's going to go crazy to the moon, while you might nominally do a higher high, it's possible. The momentum still looks terrible. It's unwinding. You don't have as much up pressure. So combine that. That's the SPX portion. Now you have gold still going upwards, but probably stalling. But the gold to SPX ratio trying to go upwards. As soon as SPX tanks, as long as gold holds its ground or doesn't go down as much as SPX, the gold to SPX ratio is going to rocket upwards, breakout, and that's a precious metals bull era. That's how you define it.
Yeah, I think I had another question, but I think you already answered it. So you think and I guess the ratio is really, really key. You don't really need gold to go up. You just need the ratio to close to really have a really strong bull market because money would flow into gold. That's your thesis, correct?
Yes. It will flow more. So when you have a ratio chart, they will flow more into precious metals because I'll show you why it's important. So I'll put XAU, gold divided by SPX. I'll just show you that chart. I'll remove all the drawings, remove all the indicators, reset the chart view. I'll just zoom out. This chart from the 1913, let's say I overlay, I don't know, silver price, new pane, log here. You'll see that the ebbs and flow of that's a gold to SPX. This is silver. Look how silver tracks the capital flows going into gold, outperforming SPX. Here, same thing, the 2000s. So that ratio going up has a high correlation with silver. This gold was pegged here. So here was, as SPX was going up, it couldn't hold its ground, but silver did still do well prior to the unpeg. So if gold breaks out here in the new uptrend, then it favors silver price and fiat to go up. I could even overlay the miners.
Yeah.
New price scale. Where are my super duper miners? Log scale. I'm going to hide. So here, same thing for the miners. Look at that. Look at the miners, how they track the gold to SPX ratio almost to perfection in the 70s. You see this, guys? It's crazy, right?
Yeah.
The ebbs and flows, the trend, not the correlation, like tit for tat, but look at the. So the miners,
yeah,
they don't track the gold price. They track the SPX adjusted gold price, the trend of it. It's they have different COs, they have different ounces in the ground. Like they don't care. Like that's why people say, oh, the gold price at whatever, and how come the miners aren't as much? Well, you need to adjust the miners for something, right? For capital flows, you could adjust the better miners. They track gold adjusted for inflation. And the very, very, very best miners, some of them just track gold practically to a T there. There's some, that are doing all-time highs in the miners. It's a wide range, but the bulk of them, they will get less headwinds and more tailwinds once this chart here starts going bonkers upward, like it starts trending. Once it starts trending upwards, the gold to SPX ratio, the miners are just going to get so much tailwinds, you won't even believe it there. It's just going to be like, you'll be choosing anything and it'll be going up, So that's why it's important to be in a bull era. It doesn't mean they say, oh, Patrick, I can't be on the sidelines waiting for this bull era. You don't have to. The miners are in a bull market now. It's like, look, the bulk of them, look at that. There's a breakout. Like the miners in a bull market, gold's in a bull market, silver's in a bull market. I'm just telling people that the greatest gains in the shortest amount of time will happen after gold breaks out versus SPX. You'll just get more pop, more bang for your buck after that happens. But it doesn't mean you can't make, the prices can't go up right now nominally, but the crazy moves for the miners here, like in the faster and shorter amount of time moves, they'll happen, they could start happening here, right, as gold breaks out versus SPX.